Everyone is watching the obvious part of the AI story. They are watching the chips. They are watching Nvidia. They are watching the models, the software companies, the cloud platforms, the announcements, the demos, the headlines, and the valuations. But in every major cycle, the most obvious story is not always the most important story for investors. Often, the real constraint sits underneath the thing everyone is watching during a gold rush. The obvious story is gold. But the people selling picks, shovels, rail, food, tools, and financing can sometimes capture enormous value because the rush cannot happen without them. AI has a similar hidden layer. Artificial intelligence does not run on excitement. It runs on power. Every model, every data center, every cluster of chips, every training run, every inference request, every server rack, every cooling system, every cloud expansion, and every competitive race between the largest technology companies depends on one very old system, the electrical grid, and that system was not built for what is now being asked of it. This is the important point. The AI boom is not only a technology cycle, it is becoming an energy infrastructure cycle. The market has begun to understand this, but most ordinary investors still do not see the full chain of cause and effect. They look at AI and think chips. They look at chips and think software. They look at software and think productivity. But before any of that can scale, the power has to be there. No power, no data center, no data center, no AI scale, no revenue growth that justifies the capital spending. That is why the grid matters. The United States power grid is old. Many transformers are decades old. Transmission lines are constrained. Substations need upgrades. Interconnection queues can take years. The system was designed for a different age, a different load profile, and a different kind of economy. It was built for homes, factories, offices, refrigerators, air conditioners, and normal commercial activity. It was not built for AI supercomputers running 24 hours a day. Data centers are not like ordinary buildings. They need enormous and reliable power. They cannot simply operate when the sun shines or the wind blows. They need consistent electricity, cooling, backup systems, and redundancy. If the power fails, the economics of the facility fail. This is why the grid has become the bottleneck. And when the bottleneck is energy, the money begins moving toward energy. That is the part that matters. I like to reduce complicated situations to principles. One of the most useful principles in investing is simple. Follow the money. Do not follow the loudest story. Do not follow the most emotional headline. Do not follow what people say should happen. Follow where capital is actually going. Money flows reveal priorities before narratives catch up. Institutional investors understand this. They watch backlogs, contracts, capital spending, government programs, policy shifts, power purchase agreements, utility plans, order books, and sector rotation. They do not need the evening news to tell them that a trend is real. They look at where signed contracts and cash commitments are moving. That is why this power grid story is important. The market began showing it before many people understood the narrative. While the broad index moved only modestly over a period of months, companies tied to power line construction, engineering and construction, electrical components, fuel cells, cooling systems, power modules, and grid equipment began moving strongly. That is not random. It is money flowing toward a bottleneck. When a bottleneck appears in a major technology cycle, the companies that solve that bottleneck can become very important. Now, the government has added another layer. A policy change has been presented as a move to strengthen grid reliability and security. The exact political packaging matters less than the structural consequence. The government is recognizing that power reliability is now a strategic issue. It is not merely an environmental issue or a utility issue or a state-level permitting issue. It is connected to AI defense, data centers, military readiness, industrial capacity, and national competitiveness. When an issue moves from private inconvenience to national strategy, the capital flows can become much larger. That is what investors must understand. The United States is facing an energy infrastructure problem at exactly the moment AI demand is accelerating. That creates pressure on utilities, regulators, data center operators, energy producers, engineering contractors, component manufacturers, and raw material suppliers. This is not a single stock story. It is a system. And systems create multiple investment layers. The first layer is off-grid or behind, the meter power generation. This is one of the biggest changes in the story. Large data center operators cannot always wait 5 to 10 years for a grid connection. Interconnection queues can be slow, permits can take time. Utilities may need to build transmission lines and substations. Local capacity may not exist, but AI demand is moving now, not 10 years from now. So the data center companies are doing something extraordinary. They are becoming power developers. They are building or contracting their own generation capacity, fuel cells, gas generation, small modular nuclear concepts, long-term power purchase agreements, dedicated energy resources placed close to the load. This is a major shift. Private companies are no longer simply asking the grid for power. They are building power around their own needs. One type of company that benefits from this is the fuel cell provider. Bloom Energy is an example from the source material. Fuel cells can generate power on site, close to the data center, reducing dependence on grid delays. When a company signs a large deal with a major technology or cloud customer, the market pays attention because it suggests real demand rather than theoretical interest. The key is not the name alone. The key is the pattern. Data centers need power faster than the grid can provide it. Companies that can deliver reliable on-site power become more valuable. The same logic applies to small modular nuclear efforts. Oklo was cited as an example in the source material. The idea is that small nuclear reactors could provide clean, high-density, always-on power for large data center loads. Whether a specific company succeeds is uncertain. Nuclear projects are complicated. They face regulatory, technical, capital, and execution risks. But the demand logic is clear. AI needs power that is reliable. Nuclear offers baseload power. Technology companies want to claim cleaner energy sources while meeting massive electricity needs. This creates a revival of interest in nuclear solutions. And if nuclear demand grows, uranium becomes part of the chain. Camco was mentioned as a large uranium supplier. The principle is old but powerful. When a new wave of reactors or nuclear commitments appears, the input material becomes important. If supply is tight because the industry was neglected for years, prices and supplier economics can change quickly. This is the picks and shovels idea again. You do not only look at the company building the reactor, you look at the fuel, the components, the contractors, and the supply chain. The second layer is physical grid construction. This is the most direct infrastructure layer: transmission lines, substations, high voltage equipment, utility, scale construction, permitting, engineering, maintenance, and expansion. The grid cannot be upgraded by speeches. It must be built physically. Metal must be installed. Lines must be strung. Substations must be expanded. Transformers must be replaced. Labor must be organized. Engineering work must be completed. Utilities must sign contracts. This is why backlog matters. A backlog is not a dream. It is not a press release about a future possibility. It is work already sold. It is contracted revenue, expected to be performed over time. When a grid infrastructure company has a large and growing backlog, it tells you that customers have already committed. The revenue is not guaranteed in a perfect sense because execution risk always exists, but it is far more concrete than a vague projection. Quanta Services was cited as a major grid infrastructure contractor with a very large backlog. That is the kind of data serious investors study. A backlog of tens of billions of dollars means the company has visibility into future work. It means utilities, energy companies, or other customers are committing capital to actual projects. When backlogs expand across an industry, the trend is no longer only a story. It is being funded. Other contractors and builders fit into this layer as well. Mastec, Argon, and Comfort Systems were cited in the source material. Each has a different role. Some build power lines and pipelines, some build power plants. Some do mechanical and electrical contracting for data centers, including cooling and electrical systems. The investor should not memorize tickers blindly. The investor should understand the role each company plays in the infrastructure machine. The grid builder builds the physical transmission and substation capacity. The power plant contractor builds generation. The mechanical and electrical contractor equips the data center and industrial facility. The pipeline contractor may support natural gas infrastructure where gas-fired power is needed. The value is in understanding who gets paid when capital spending moves from discussion to execution. The third layer is critical electrical components. This is where the story becomes even more interesting because the grid build-out itself has picks and shovels. Every data center, substation, power line, and generation facility needs specialized components: power modules, switchgear, transformers, circuit boards, electrical distribution equipment, thermal management systems, cooling systems, power conversion devices. These are not glamorous products to the average investor, but they can be extremely important. High-performance AI chips consume enormous power and generate enormous heat. Traditional cooling systems are often inadequate. Power conversion must be efficient. Electrical distribution must be reliable. Overloads must be prevented. Data centers require specialized infrastructure because downtime is expensive and power density is rising. Vertiv, Viker, Powell Industries, TTM Technologies, and Advanced Energy were cited as examples tied to this component and infrastructure layer. Again, the principle is not that every named stock is automatically attractive at every price. That would be too simplistic. The principle is that electrical complexity rises as AI power demand rises. The companies with specialized products that solve those problems can see demand increase. This is why the component layer can sometimes outperform the headline theme. If everyone knows AI needs chips, the chip stocks may already be crowded. But if fewer people understand that each new AI data center requires cooling, switchgear, power modules, circuit boards, transformers, and specialized electrical infrastructure, the opportunity may be less obvious. Markets eventually discover bottlenecks. The advantage is to study them before the mainstream narrative becomes simple. The fourth layer is raw materials. You cannot rebuild a grid out of imagination. You need aluminum for transmission lines and conductors. You need copper for wiring, transformers, motors, and electrical systems. You need uranium if nuclear power becomes a larger part of the mix. You may need steel, specialty metals, industrial equipment, and other inputs. Raw materials are often cyclical and volatile, but they matter because infrastructure spending translates into physical demand. Aluminum companies and domestic producers were mentioned in the source material, particularly in connection with tariffs and the idea that rebuilding with domestic materials could benefit U.S. suppliers. Alco and Century Aluminum were cited as examples. The principle is that policy can redirect demand toward domestic supply chains. If the government wants to strengthen energy security and grid resilience, and if tariffs raise the cost or reduce the attractiveness of foreign supply, domestic producers may benefit. But raw material investments require caution. Commodity companies are sensitive to global prices, capacity, energy costs, tariffs, demand cycles, and balance sheet strength. A company can benefit from a theme and still be a bad investment if the price already reflects too much optimism or if costs rise faster than revenue. So the correct approach is not to buy blindly, it is to understand the demand chain, then evaluate the specific company valuation, balance sheet, and cycle. The fifth layer is the framework itself. This may be the most valuable part because a list of companies becomes stale, but a framework can be reused. The framework begins by zooming out, ask what is already happening at a scale too large to ignore. Not what might happen if a story becomes true, what is already happening. In this case, AI data centers are being built. They need enormous power. The grid is old and constrained. Interconnection is slow. Government policy is moving toward reliability and security. Utilities and data center operators are committing capital. Backlogs are expanding. Stocks in the power infrastructure chain have already been moving. That is the macro trend. Then ask who benefits. Do not simply buy the most obvious stock in the most obvious headline. Break the trend into required steps. AI requires data centers. Data centers require power. Power requires generation. Generation requires fuel, equipment, and contracts. The grid requires transmission substations. Transformers and construction data centers require cooling, electrical systems, and power conversion. All of that requires raw materials. Then ask which companies have evidence of demand, backlogs, signed contracts, power purchase agreements, order growth, revenue visibility, government or utility customers. This is where the story becomes investable. A company saying it might benefit is not enough. A company with signed work, growing backlog, and customers spending money is a different matter. Then ask whether the price already reflects the opportunity. This is critical. A good theme can become a bad investment if the stock has already moved too far relative to fundamentals. A company can be positioned correctly and still be overvalued. A sector can be attractive and still have sharp corrections. That is why risk management matters. The goal is not to be first at any cost. Being too early can be dangerous because capital can sit idle. The market may not recognize the trend and the company may need years to execute. Being a little late after the data confirms the trend can sometimes reduce uncertainty. The key is not early or late in a vague sense. The key is whether the risk reward is still attractive. That is how institutional investors think. They do not need to catch the first dollar of the move. They want to participate when the probability improves and the trend is visible before the crowd fully prices it. Now let me talk about the role of policy. Policy does not create all value by itself. A government order does not magically make every energy stock a winner. But policy can accelerate capital flows, reduce permitting friction, increase urgency, support contracts, and change the economics of certain assets. When the government says grid reliability and security are priorities, certain assets become more strategic. Coal and gas plants that were scheduled for retirement may be kept online longer because the system cannot afford to lose capacity. Power purchase agreements for military and critical facilities can create long-term revenue streams. Transmission upgrades can receive support. Utility planning can change. Data center operators can accelerate private generation deals. That does not mean every decision is clean or efficient. Energy policy is full of trade-offs. Coal and gas provide reliability but emit more. Solar and wind are cleaner but intermittent. Nuclear is baseload but complex and politically sensitive. Batteries help but have their own supply chains and limitations. Transmission is necessary but slow to permit. Data centers create economic activity but strain local grids. This is a system of trade-offs. The investor's job is not to argue emotionally about which energy source is morally perfect. The investor's job is to understand what the system must do to keep operating. AI demand requires reliable power. Reliable power requires capacity. Capacity requires capital. Capital flows to companies that can deliver. That is the chain. Now, the source material emphasized that many power-related stocks had already moved strongly. That matters because it tells us the opportunity is not completely hidden anymore. When a stock is already up 50%, 100% or more, the risk changes. The theme may still be early in a multi-year build-out, but the stock may not be early in the short-term move. This is where many investors make mistakes. They see a strong trend and assume the next move is automatic. But price matters, entry matters, position size matters, valuation matters, earnings revisions matter. The best company in a good sector can still fall sharply if expectations get too high. So I would think about this in probabilities. The grid and energy infrastructure trend appears structurally real because the underlying demand is real, but individual stocks tied to the trend may be volatile because they have already moved, because earnings may not keep up with expectations, because policy can shift, because projects can be delayed, and because the broad market can correct. Therefore, the correct behavior is not to chase emotionally. The correct behavior is to build a watch list, study the backlogs, compare valuations, wait for reasonable entries, size positions carefully, and monitor whether the data continues to support the thesis. That is how you turn a theme into a process. Most retail investors do the opposite. They wait until the story becomes obvious, buy the stock that has already gone up the most, ignore valuation, hold no plan for risk, and then panic when the inevitable correction comes. That is not investing. That is being the last buyer in someone else's trade. The follow. The money framework helps prevent that. It tells you to look at evidence before emotion, backlog before hype, contracts before commentary, capital spending before slogans, relative strength before consensus coverage, order books before social media narratives. Now, there are 5 major buckets to understand in this AI power grid cycle. The first bucket is on-site generation, fuel cells, gas generation, small nuclear and private power infrastructure tied directly to data centers. The second bucket is grid construction, transmission lines, substations, high voltage infrastructure, utility construction, and engineering services. The third bucket is power plant and data center contractors, companies that build generation, cooling systems, electrical systems, and mechanical infrastructure. The fourth bucket is electrical components, switchgear, power modules, circuit boards, transformers, thermal management, and power conversion. The fifth bucket is raw materials, aluminum, copper, uranium, and other inputs required for grid expansion and power generation. A strong investor does not need to own every bucket, but they should understand all of them because money can rotate within the theme. At one moment, fuel cell providers may lead, at another, grid contractors at another, cooling and electrical component companies at another, uranium or aluminum at another, utilities or independent power producers. Themes do not move in straight lines, they rotate. That is why understanding the system is better than memorizing a list. Now, let us examine the AI demand side more carefully. Data centers are among the most electricity-intensive assets in the modern economy. AI workloads are especially demanding because training large models and running inference at scale require dense clusters of high-performance chips. Those chips need power and cooling. As AI applications expand into search, enterprise software, robotics, industrial systems, video, coding, customer service, defense, healthcare, and finance, the demand for compute rises. Compute demand becomes data center demand becomes electricity demand becomes grid and generation demand. This is why the AI story cannot remain confined to semiconductors. The physical world must support the digital world. That is one of the most important investment ideas of the next cycle. The digital economy always depends on physical infrastructure. Investors sometimes forget that because software feels weightless, but every cloud application lives inside a building. Every server sits on land, every chip uses electricity, every watt becomes heat, every heat problem requires cooling, every facility requires grid connections, substations, backup generation, and equipment. The physical layer may be less glamorous than the software layer, but it is not less important. In some cycles, it can become the better investment. That is what investors must study. Now the grid constraint has another consequence. Utilities may need to spend enormous sums, capital expenditure plans may rise, transmission investment may accelerate. Regulators may allow certain returns on capital, industrial customers may sign long-term agreements. The utility model may change in regions with heavy data center demand, but utilities themselves are not always simple beneficiaries. They may face regulatory delays, cost recovery issues, customer backlash, reliability risk, and capital intensity. Some may benefit, others may struggle. That is why the contractors and component suppliers can sometimes be more direct plays than the utilities themselves. Again, follow the money to the point where revenue is contracted and margins are attractive. Do not assume the company at the center of a problem captures the value. Sometimes the supplier captures the value, sometimes the contractor, sometimes the raw material producer, sometimes the financing entity, sometimes the bottleneck component maker. The value often accrues to the scarce part of the chain. So ask, what is scarce? Power capacity is scarce. Grid interconnection is scarce. Transformers can be scarce. Skilled electrical labor can be scarce. Cooling expertise can be scarce. Uranium supply can be scarce if nuclear demand accelerates. Copper and aluminum supply can tighten if infrastructure spending rises. Permitting capacity can be scarce. Backlog visibility can be scarce. The scarce thing has pricing power. Investors should look for pricing power. Now, the source material mentioned emergency powers to keep power plants open. This is important because it shows that reliability may begin to override earlier assumptions about energy transition. If data centers and national security require constant power, policymakers may keep coal and gas plants running even if they were scheduled to retire. That has implications for gas infrastructure, power plant maintenance, environmental policy, and utility planning. It also shows that energy transitions are rarely clean straight lines. The world may want cleaner energy, but the grid must remain stable. Intermittent power sources require storage, transmission, backup, and management. Data centers need always-on power. This creates a messy reality where old and new energy systems coexist longer than political narratives suggest. Investors who think in slogans will miss this. Investors who think in constraints will understand it. The constraint is reliability. The system will pay for reliability. That means baseload, backup, transmission, storage, generation diversity, and grid hardening all matter. Now let us talk about power purchase agreements. A power purchase agreement is not exciting language. It sounds boring. But boring contracts can be very valuable. A long-term contract to buy power can create revenue visibility for the provider. If the customer is a high-quality technology company, military facility, utility, or government-related entity, the counterparty quality may be strong. This is exactly the kind of thing serious investors like: recurring or contracted revenue, long-duration, high-demand end market, critical infrastructure, strong customer. That is different from speculative revenue. So when you study companies in this theme, look for the quality of contracts. Who is the customer? How long is the term? What is the volume? What are the margins? What are the capital requirements? How much execution risk exists? Does the company have the balance sheet to deliver? The headline deal is only the first layer. The economics are the second layer. A great contract with poor margins or huge capital strain may not create shareholder value. A smaller contract with strong economics and repeat potential may be more valuable than it looks. Details matter. Now let us consider the risk that investors are too late. Some of these stocks have already moved dramatically. That can make people afraid to enter. Sometimes that fear is correct. Chasing a parabolic move can be dangerous. But sometimes a stock that appears to have moved a lot is still early in a multi-year earnings cycle. If the fundamentals keep accelerating, the question is not, how much has it gone up? The question is, how much has the market already priced in relative to future cash flows? A stock up 100% can be expensive. A stock up 100% can still be cheap if earnings are about to rise much more than expected. A stock that has not moved can be attractive. A stock that has not moved can also be a value trap if it lacks real exposure. Price movement alone is not enough. You need the relationship between price, fundamentals, expectations, and time. This is why I prefer the idea of being confirmed early rather than blindly early. Blindly early means buying before evidence exists, hoping the story becomes true. Confirmed early means the evidence is public, the money is moving, the contracts are appearing, the market has begun to respond, but the mainstream has not fully understood the scale. That is the sweet spot, not always available, but worth looking for. Now, how would I structure the research process? First, identify the undeniable demand. AI data centers need power. Second, identify the bottleneck. The grid is old, interconnection is slow, reliable capacity is limited. Third, identify the policy response, government support for reliability, security, power capacity, transmission, and critical infrastructure. Fourth, map the value chain, generation, transmission, construction, components, cooling, raw materials. Fifth, identify public companies in each bucket: fuel cells, nuclear, uranium, grid contractors, power plant contractors, data center electrical contractors, switchgear, cooling, power modules, aluminum, copper. Sixth, look for evidence, backlog growth, signed contracts. Revenue acceleration, margin expansion, capacity additions, customer announcements. Seventh, evaluate price and risk. Valuation, balance sheet, debt, dilution, cyclicality, project execution, customer concentration, policy dependence, technical risk. Eighth, manage position size. No theme is certain. No company is risk-free. No policy trend removes market volatility. This is a process. A process is what protects you from hype. Now let us think about how ordinary investors usually fail in themes like this. They begin with the headline, then they buy the most talked about name. They ignore whether the stock has already moved. They do not know the company's backlog. They do not understand the difference between revenue and contracted work. They do not compare margins. They do not evaluate debt. They do not know whether the company is a direct beneficiary or just loosely associated. They buy too much. Then, when the stock drops, they do not know whether the thesis is broken or whether volatility is normal, so they sell badly. The solution is to know what you own before you own it. If you buy a grid contractor because backlog is expanding, then backlog is one of the variables to monitor. If the backlog continues growing and margins hold, a drawdown may be opportunity. If backlog slows, margins compress, or projects are delayed. The thesis changes if you buy a fuel cell company because data centers are signing on, site power deals, monitor the contracts, margins, customer concentration, manufacturing capacity, and execution. If you buy a uranium supplier because nuclear demand is reviving, monitor uranium prices, production costs, supply contracts, reactor announcements, geopolitical supply risk, and inventory. If you buy an electrical component company because data centers need cooling and power conversion, monitor orders, lead times, gross margins, customer mix, and competitive pressure. Every thesis needs a dashboard. Without a dashboard, you are just hoping. Now, one of the most important parts of this story is that it is not dependent on only one company. AI demand can create winners across multiple layers that reduces the need to find the perfect single stock. You can think in baskets or tiers. A conservative investor might focus on larger profitable infrastructure and industrial companies with real backlogs. A more aggressive investor might include fuel cells, small nuclear, or specialized component companies. A commodity-focused investor might look at uranium, copper, or aluminum exposure. An investor who does not want single-name risk might study ETFs related to infrastructure, utilities, industrials, nuclear, uranium, or power equipment. Though the composition and fees must be understood, the point is to match the exposure to your risk tolerance. The theme may be real, but your personal financial life must survive if timing is wrong. Good themes still have drawdowns, great companies still correct, policy trades still disappoint, infrastructure projects still get delayed. Do not confuse a strong macro trend with a guarantee of smooth returns. Now, let us talk about the role of the S&P 500. Many people sit in the index and feel frustrated when the index moves slowly while certain sectors are surging. That frustration can lead to chasing. But the correct lesson is not that the index is bad. The lesson is that beneath the broad market, leadership rotates. In some periods, mega-cap technology leads, in others, energy, in others, industrials, in others, utilities, in others, commodities, in others, infrastructure. A broad index gives exposure to the overall economy and can be a strong long-term vehicle. But if an investor wants to find opportunities inside the market, they must study sector rotation and money flows. That requires effort. It is not necessary for everyone. A disciplined index investor can do very well over time, but if you want to identify themes before they become obvious, you must look beneath the headline index. Look at relative strength. Look at sector performance. Look at earnings revisions. Look at backlogs. Look at capital spending. Look at policy catalysts. Look at where institutions are already buying. The market often shows the truth before the story becomes mainstream. That is what follow the money means. Now, there is a temptation to call every early move manipulation or insider trading. Sometimes markets do have information asymmetries. Sometimes insiders understand things before the public. Sometimes people close to policy may position early. But in many cases, the data is already public. The filings are public. The contracts are public. The backlog numbers are public. The stock charts are public. The policy discussions are public. The capital spending plans are public. The difference is that most people are watching the wrong screens. They watch commentary. Institutions watch flows, they watch orders, they watch capital commitments, they watch what customers are doing with real money. That is a learnable skill. You do not need to know everything, but you need to stop confusing news consumption with investment research. News tells you what people are saying, money tells you what people are doing. In markets, what people do with capital matters more than what they say with words. Now, let me bring this back to AI. If AI continues to scale, power demand continues to rise. If power demand rises faster than the grid can adapt, the bottleneck intensifies. If the bottleneck intensifies, capital flows into generation, transmission, grid hardening, cooling, and components. If policy supports that spending, revenue visibility improves for certain companies. If backlogs expand, earnings may follow. If earnings follow, stocks can continue to respond. That is the positive chain. But there is also a risk chain. If AI capital spending slows, power demand forecast may come down. If projects are delayed, contractors may disappoint. If policy changes, incentives may shift. If interest rates rise, capital-intensive projects become more expensive. If stocks have already priced in perfection, even good news may not be enough. If commodity supply responds too quickly, raw material prices may weaken. If companies cannot execute, backlog may not become profit. A good investor holds both chains in mind, opportunity and risk. That is how you avoid becoming a believer rather than an investor. Believers ignore risks because the story feels important. Investors respect risks because the story may already be reflected in price. The goal is not to be emotionally bullish. The goal is to be analytically positioned. Now, what would make this theme more durable? Long-term power purchase agreements from high-quality data center customers, government contracts for military and critical infrastructure, utility capital expenditure plans rising for multiple years, backlogs increasing faster than revenue, margins holding or expanding despite cost pressures, shortages in key equipment such as transformers or switchgear, policy support that reduces permitting barriers, continued AI capital spending from major technology companies, rising demand for cooling and power conversion systems, nuclear project commitments that increase uranium demand. Domestic materials policy supporting us producers. These are the kinds of data points I would monitor. What would make me more cautious? Backlogs flattening, project cancellations, margins falling because costs rise faster than contract pricing, customer concentration becoming extreme. Stocks rising far faster than earnings expectations, policy delays, financing stress, major AI capex cuts, commodity price spikes that hurt project economics, regulatory pushback, balance sheet deterioration. Again, the theme is not enough. The data must keep confirming it. Now, I want to discuss the psychological side. When a sector runs hard, people feel regret. They think, I missed it. Then they either chase too late or avoid it completely. Both can be mistakes. Missing the first move does not mean there is no opportunity left. Multi-year infrastructure cycles can have many entries, pullbacks, rotations, and second-order winners. But missing the first move also does not mean you should buy blindly because you are angry at yourself. Regret is not a strategy. If you miss the first wave, do the work, build the map, find the companies that have not yet moved as much but have real exposure. Wait for pullbacks in the leaders. Study the component suppliers, study the raw materials, study the backlog data, build position sizes slowly, or decide the risk. Reward is no longer good and move on. There are always other opportunities. A mature investor does not need to catch every trade. They need to avoid the trades that can seriously damage them and participate in enough good ones with discipline. Now let us think about the naming of this as an energy law or executive order. Political labels can create emotion. Some investors will like it because of the politician involved. Others will reject it for the same reason. That is not useful. Policy should be evaluated by incentives and cash flows, not emotional loyalty or opposition. If a policy directs capital toward grid reliability, the investor asks which companies receive contracts, which projects accelerate, which costs rise, which sectors benefit, and which assumptions change. Politics is the trigger, cash flow is the analysis. Do not let political emotion blind you to economic consequences. Now, the story also touches on something bigger. The United States is trying to maintain leadership in AI. AI leadership requires data centers require power requires infrastructure requires materials, labor, capital, and time. Therefore, AI leadership is no longer only a software or semiconductor question. It is an industrial policy question that is a big shift for many years. The market rewarded asset-light digital businesses, software could scale quickly, margins were high, physical constraints seemed less important, but AI is changing that. The new digital economy is extremely physical. It needs chips, fabs, power, cooling, land, water, transmission, and materials. This may benefit industrial companies that were ignored during the pure software era. It may also change how investors think about growth. Growth can come from concrete, steel, wires, turbines, reactors, transformers, substations, and cooling systems, not only from code. That is why this grid story matters. It suggests that the AI trade is broadening from chips to infrastructure. When a trade broadens, investors must update their map. Now, there is a risk that people overstate the certainty. AI demand forecasts can be wrong. Technology may become more energy efficient. Data center utilization may differ from projections. Policy can change. Some projects may be speculative. Grid spending can take longer than expected. Permitting remains difficult. Local opposition can slow development. Supply chains can bottleneck. So again, do not assume a straight line. But the broad direction is still important. The current AI build-out is already creating real power demand. The grid is already constrained. Companies are already signing deals. Contractors already have backlogs. Components are already in demand. That is enough to study seriously. The investor does not need perfect certainty. The investor needs a favorable probability, good evidence, and proper risk management. Now, how would I translate the framework into a simple mental model? Start with the load. Where is demand rising? AI data centers, then move to the constraint. What prevents supply from meeting demand? Grid capacity, power generation, interconnection, cooling, electrical equipment. Then move to the capital. Who is spending? Big technology companies, utilities, government agencies, data center operators, energy providers. Then move to the contracts. Who has signed work? Which companies have backlogs? Which suppliers have order growth? Then move to the financials. Can the company turn demand into profit? Then move to the price. Is the stock still reasonable relative to the opportunity? Then move to risk. How much can I lose if the thesis is wrong or early? This is a disciplined chain. If you skip steps, you are guessing. Now, I also want to point out that some of the best opportunities may not be the ones with the most exciting stories. A company making switchgear may sound boring. A company building substations may sound boring. A company providing cooling equipment may sound boring. A company producing aluminum may sound boring. But boring does not mean unprofitable. Sometimes boring is where the money flows, because the work must be done. In investing, excitement often attracts competition. Boring necessities can be overlooked until the earnings show up. The grid does not care whether a component is exciting. It either needs it or it does not. If it needs it and supply is limited, the economics can become attractive. That is what matters. Now I want to talk about time horizon. Grid infrastructure is not a one-quarter story. Transmission lines, substations, power plants, nuclear projects, data center campuses, and utility upgrades take years. That can be good because it creates multi-year visibility. It can also be difficult because execution is slow and delays are common. A short-term trader may focus on momentum. A long-term investor should focus on whether the capital spending cycle has durability. If the build-out is truly multi-year, there will be corrections along the way. The question is whether those corrections occur inside a continuing trend or whether the trend itself breaks. That is why monitoring the data matters. Backlogs and orders can tell you whether the trend remains intact. Now let me discuss risk management more directly. Do not put your entire portfolio into a grid theme because it sounds inevitable. Nothing is inevitable at the level of a stock. The theme can be right and your stock can be wrong. The theme can be right and your timing can be wrong. The theme can be right and valuation can be too high. The theme can be right and a company can fail to execute. Therefore, position sizing matters. A theme exposure should fit within a diversified portfolio. You can use baskets, you can size speculative names smaller, you can favor profitable companies with backlogs over pre-revenue ideas. If your risk tolerance is lower, you can wait for pullbacks, you can decide that a stock is too extended and simply watch. Watching is allowed. Not every good idea must be bought immediately. The market will still be there tomorrow. The goal is not to act fast. The goal is to act well. Now, let us consider what most people will do. They will hear that AI needs power, see a list of stocks, and look for the one that has gone up the most. Then they will buy because they want to participate. That is not the right way. The right way is to separate the companies by role: off-grid generation, nuclear and uranium transmission construction, power plant construction, data center electrical and cooling contractors, electrical components, raw materials. Then compare each company within its role, which has the largest backlog, which has the best margins, which has the strongest balance sheet, which has customer concentration risk, which has already priced in too much growth, which is still underfollowed, which has second-order exposure, which benefits from policy and private capital, which depends too much on one project. This is how you move from a story to an investment process. Now there is another interesting issue: domestic supply. If government policy favors us materials, domestic producers may benefit. Tariffs on foreign metals or incentives for American-made infrastructure can change the economics. This is why aluminum, copper, and other domestic supply chain companies become part of the analysis. But tariffs are double-edged. They can help domestic producers but raise costs for buyers. Higher input costs can pressure project economics. Policy can shift, trade disputes can develop. Commodity investing is never simple. Again, the correct posture is balanced. Understand the benefit, understand the cost. Now what about environmental constraints? Some of the power solutions needed for reliability may include natural gas or keeping older plants online. That may conflict with climate goals. Nuclear may be politically controversial. Transmission lines may face local opposition. Data centers may face criticism for power and water use. These factors can slow projects or change which companies benefit. The energy system is not purely financial. It is political, environmental, technical, and local. This complexity creates both risk and opportunity. Companies that can navigate permitting, regulation, utility relationships, and engineering constraints may have an advantage. Companies without that ability may struggle even if demand is strong. So management quality matters. Execution matters. Relationships matter. History of delivering projects matters. A backlog is valuable only if the company can execute it profitably. Now let us think about the broader investment lesson when a huge trend appears. The first order winners are obvious. In AI, the first order winners were chips and cloud. The second order winners may be power, cooling, grid components, and materials. The third order winners may be financing real estate around data centers, water infrastructure, cybersecurity, and specialized labor. Investors who only chase first order winners often arrive late. Investors who understand second and third order effects can find opportunities where the crowd is slower. This is the real value of systems thinking. Ask what must happen for the obvious trend to continue. Then look for the companies that provide those necessities. AI must have power. Therefore, power is not optional. The grid must be upgraded. Therefore, grid infrastructure is not optional. Data centers must be cooled. Therefore, cooling is not optional. Electricity must be converted and controlled. Therefore, power electronics are not optional. Materials must be supplied. Therefore, raw inputs are not optional. These are necessity chains. Necessity chains can create durable demand. Now, the market will not reward every necessity equally. Some industries are low margin, some are regulated, some are cyclical, some have too much competition, some require heavy capital investment. That is why company selection still matters. But the necessity chain tells you where to look. It narrows the search. That is the practical advantage. Now let me address the idea that the government has committed over $1 trillion to rebuild the grid. Whether the exact number is structured across programs, private spending, utility capital expenditures, federal support, or broader infrastructure needs, the core idea is that the scale of required investment is enormous. The grid is a multi-trillion-dollar problem over time. Modernizing it will not be cheap. When a problem is that large, multiple companies can benefit. The opportunity is not limited to one winner, but large spending does not automatically mean shareholder returns. Government money can be slow, margins can be regulated, cost overruns can occur, labor shortages can limit execution, contracts can be competitive. So again, follow the details. Which companies are actually winning work? Which companies have pricing power? Which companies can expand capacity? Which companies can protect margins? Which companies have enough labor? Which companies have execution history? The data is the difference between a theme and a thesis. Now, the three-step framework can be simplified. First, find the undeniable trend. Second, identify the bottleneck and beneficiaries. Third, confirm with money flows and backlogs that framework can be used beyond AI power. If healthcare spending rises, find the bottlenecks. If defense spending rises, find the backlogs. If housing shortages persist, find the suppliers and constraints. If reshoring accelerates, find the industrial and logistics beneficiaries. If water scarcity rises, find the infrastructure companies. The framework is portable. That is why it is more valuable than a list of stocks. A list tells you what someone else found. A framework helps you find the next thing yourself. Now, I want to bring the story back to individual investors. You do not need to be a Wall Street professional to think this way. The information is often public, company filings are public, earnings calls are public, backlog numbers are public, policy announcements are public, stock charts are public, sector performance is public. The issue is not access, it is attention. Most people give attention to the loudest information, not the most useful information. They watch opinions. They do not study commitments. They listen to predictions. They do not read order books. They chase headlines. They do not compare sector strength. They ask what stock to buy. They do not ask what money is already doing. Changing that attention is an edge. Now, let me be clear about financial advice. I am not telling anyone to buy a specific stock. I am not saying these companies will go up. I am not saying the theme is risk. Free the right decision depends on your portfolio. Time horizon, risk tolerance, valuation work, tax situation, and ability to handle volatility. What I am saying is that the AI power infrastructure chain deserves serious attention. It is connected to a real demand problem. It is connected to policy support. It is connected to visible capital flows. It is connected to companies with backlogs and contracts. It is connected to a bottleneck the market cannot ignore forever. That makes it a serious theme. Serious themes deserve serious analysis. Now, what should you do after hearing a theme like this? Do not rush, build the map. Write down the buckets, write down the companies in each bucket. Look up their revenue margins, backlog, debt, cash flow, valuation, and recent stock performance. Read the last earnings call. Check whether management is talking about data centers, grid demand, power generation, or utility spending. Compare the stock move to the change in fundamentals. Ask whether the company is a leader, a supplier, or only loosely connected. Then decide whether the opportunity fits your process. That is the work. The work is what separates investing from entertainment. Without the work, the theme becomes entertainment. You feel excited, but nothing durable happens. Or worse, you buy emotionally and lose money. With the work, the theme becomes a possible opportunity. That is the difference. Now let me end by restating the main idea. AI is not only a chip story anymore. It is becoming a power story. The United States grid is old and constrained. AI data centers require enormous reliable electricity. Major companies cannot wait years for connections, so they are looking at on-site generation and long-term power deals. The government is pushing grid reliability, and security contractors, component suppliers, generation providers, nuclear-related companies, uranium suppliers, aluminum producers, cooling companies, and power electronics firms may all be part of the capital flow. The investor's job is to follow that money carefully, not emotionally, not politically, not blindly, carefully. Look for signed contracts, look for backlogs, look for relative strength, look for capital spending, look for margin expansion, look for supply constraints, look for the bottleneck, then manage risk. This is how I would think about the opportunity. The crowd watches the headline. The serious investor watches the constraint. The headline is AI, the constraint is power. And when a constraint controls the growth of a major trend, the companies that solve the constraint can become far more important than most people expect. That does not mean the trade is easy. It means the work is worth doing. In every cycle, there are people who chase the obvious story late, and there are people who study the machinery underneath it. The machinery underneath AI is electricity. If you understand that before the mainstream fully does, you may see opportunities others miss. But remember the principle. The opportunity is not in believing a story. The opportunity is in understanding the flow of money, the structure of demand, the bottleneck in supply, and the companies with evidence that they are already being paid to solve it. That is how you move from noise to signal. And in markets, signal is everything.